Hey guys, welcome back. Now, following is an interview with Gareth Soloway of InTheMoneyStocks.com. And after a terrible year in 2022, we were talking about everything to do with 2023 and where are the markets going. And we'll be looking at stocks, we looked at bonds, we looked at gold, we looked at crypto and the latest price move. Was the latest price move in crypto the start of a new bull market or just a bull trap to be avoided? As always, if you do enjoy anything in the video, then drop a like and a big thank you to everyone who does. And without further ado, let's get to the interview. So, Gareth, welcome back to the channel. It's been a while.
It has been a while. Great to be back here in the new year with you.
Yeah, so obviously we've just wrapped up 2022, and I'd say for the longer term investor, it was a pretty crappy year.
Yeah.
Pretty much everything went down. Stocks went down, bonds went down, gold and silver went down, anything sort of in the risk bucket went down. Crypto obviously got hammered. How would you summarize 2022?
It was a tough year. There's no doubt about it. It was a year where we had to start paying for our past expenses, meaning that the Federal Reserve was on a money printing frenzy, which gave us so much extra money in the economy, in the markets. And now was a time where we had to kind of pay the piper. So I think again, it's to understand that much wealth and that much kind of over expenditure comes at a cost. And I think 2022 was showing us that at this point, we have to tighten our waist. It's going to be a little tougher going forward without the Fed printing all this money.
So obviously that's in the past. So let's look forward to 2023 and we'll look at all the core charts from a technical analysis point of view. We'll start with crypto. We'll look at stocks. We'll look at bonds. We'll look at gold. And yeah, so let's start with crypto, which is probably most of the people watching this is interested in. I think everybody's very excited because of the recent pop in prices. But we have to say, is this the start of a bull market, or are you in the camp that says this is a bull trap?
Yeah, so I'm more in the camp of it's a bull trap. And I know there's so much excitement out there, but I do caution investors. And I've been through many, many bull markets and bear markets and bull traps and bear traps, that this has the hallmark of making a bear trap or bull trap. And I say that because, number one, it was a great rally, but notice where we stalled as of now. This was the beginning of the FTX collapse. And so on a technical basis, this is huge resistance. And we're only back to that point. And I know it seems like a great move. We went from 16,000 and change right up to 21 and change. But if you zoom out on the charts, look at the tiny nature of that bounce. And so to get over exuberant in terms of believing it's a new bull market, I think you have to take a little bit of time here to just see how it trades in the next couple weeks, if you will. So I'm personally in the camp that I think that this is a risk-on environment in January of the new year. I think people think new year, new crypto, new year, stocks can go higher. There's this rebirth at the new of the year where everyone kind of says, okay, the old is done, let's focus on the new. And I think that's creating a lot of these buyers and short squeezes in these stocks. We've seen GameStop, AMC, Bed Bath Beyond rip higher, like 50, 100% moves, very reminiscent of the Wall Street Bets runs that they saw in 2021 as well. So I don't see a fundamental shift yet in the underlying key parts to the crypto market or the stock market. And that makes me concerned that, again, it could be a bull trap. So in terms for me, I'm looking at it more like this is a push to sell some of my longs into in crypto versus accumulating and buying, thinking we're going to be at all-time highs in the next, couple months.
Yeah, I have to say that I tend to agree at this point. I'm always a fan of having a plan for both directions, but I just think the macro picture, the big picture, when you've got the Fed doing QT and then the money printing has stopped, pulling out liquidity. And then you've got interest rates that just keep going higher, even though like inflation may be better than expected. As long as interest rates are going up and QT is on the cards, I just can't see everything turning around at this point.
Yeah. I think you're 100% right in that. And think about this, right? Since 2009, which is when the Fed started printing, and by the way, when Bitcoin came into existence, everyone kept on saying, don't fight the Fed. The Fed's printing money, right? So now all of a sudden they stop printing money, markets go down, which is what you would expect. But now people are trying to fight the Fed and saying, well, there's a bottom in, we're going to go back to all-time highs. And so you really have to use the same logic as pre-2022 versus, after 2022. If it wasn't to fight the Fed when they were printing money, well, if they're sucking money out, we shouldn't be trying to fight the Fed as well.
So if you work on the thesis of a bull trap, my next question is, with all the price data that we've got now, what is your latest price target for a crypto bottom and at what point? Tough questions, but
so this is always the hardest, right? Because, picking bottoms is hard enough to what price is it going to, but then timeframes. And all I can do for myself is say, I think that regulation will be out in the next 6 months. So I think that is going to give us some clarity in terms of, what projects are good projects. Can we see audits on these projects, on these exchanges? That's going to give confidence to investors. And then also looking back, and I look back and I say, okay, well, if FTX was the Lehman Brothers of crypto, and obviously Lehman Brothers occurred in 2008 where that big bank failed and created a kind of a panic in the banking and in the stock market. It took about 6 months for the markets to bottom back in 2008 into 2009, and it dropped the markets about 45%. So if you look at that from where that news came out, it puts us right around 10,000 or 9,000 on Bitcoin, and it tells us maybe May or June as a potential bottom. And obviously, it's so hard to figure out, especially on an asset as young as Bitcoin. But that's kind of what I'm leaning towards. I'm leaning for a bottom this year, probably in the second quarter of 2023. And then ultimately, I think the regulation will turn out to be an amazingly positive thing for Bitcoin in the second half of the year going into 2024 and the halving.
And let's say we're wrong. What price target would Bitcoin have to break to go, do you know what? This is a bigger trend reversal and it looks like a full reversal has happened?
That's a good one. You're bringing out the good questions today. That's certainly true. So for me, I'm looking back at this M top, right? So this M top here, we obviously have seen selling here. For me to really get bullish, I would want to see us take out this level right here. So this is obviously what we came down to here. Then we hit it here and we finally broke through. If we could reclaim that level, then I think you have to say we're now closer to the all-time highs than the lows on Bitcoin. And you probably get a pretty successful continuation move back to the highs on Bitcoin around 69,000. So that to me is a real line in the sand. I think in the near term, if you're just watching for momentum, the FTX high psychologically is a big level. As we can see, it's struggling at that level now. But that wouldn't, if we broke above it, that wouldn't make me think, okay, we're now in a bull market. It would just be, okay, that's a good sign of strength for Bitcoin. This upper level would change my mind. If we can get above there and establish ourselves, that would be really impressive.
Yep. So that's about the $40,000 mark, isn't it?
Yep.
All right. Well, let's move on to stocks. S&P 500. What do you see going on for 2023?
Yeah, so with the S&P 500, I am concerned, and I think the first half of the year may be a little bit better than the second half. I know a lot of people had said the first half would be worse and the second half would be better, but I'm leaning towards the first half seeing a lot of chop as the Fed kind of starts to say, okay, we're going to stop our tightening phase, but we're going to stay at neutral. So just that alone will give the market some relief rally. But then I do worry that in the second half of the year of 2023, we're going to see a recession hit. And the problem with a recession is, number one, every economy has to go through them every so often. The issue now is that inflation will likely remain elevated, not at 6%, not at 8%, not at 10%, but at 3 or 4%. And that's going to make it very hard for the Fed to come out and stimulate. Even lowering rates is going to be tricky because they're going to be very concerned that by lowering rates, it then creates more money supply and we're going to see inflation roar back. So if we get into a recession and the Fed doesn't come to the rescue like they've done since 2009, that to me is a reckoning for the stock market that we're going to have to face. And to me, that means lower equity prices by a significant margin, because we could be looking at a long-term recession that lasts for multiple years, like 3 to 5 years. It may not be a horrendous like Great Depression, but I could just see this economy getting to a point where it's just kind of recession, minor recession, but for like a long period. And that's kind of a scary thing for investors to think that Apple and these other companies may not be able to earn significantly more money on a yearly basis year over year.
And as far as price targets, I mean, the S&P 500, it doesn't go below 50% many times. I think 1929, obviously, the big ones, year 2000, 2008. Do we think this is a time where it's going to break below a 50% drop?
So I think so for me, at least, looking at the charts is, number one, we're right up against this longer term down sloping trend line. Here's where the S&P is trading today, right here. So that's number one, is that we're into resistance. Number two is that we still haven't corrected to where we were just before COVID occurred, right? So here's your high from February of 2020. Here's your collapse on the COVID panic that we saw. So in the very least this year, we should test 3,400. My guess is, though, is that we're going to go to a longer term trend line, which stretches all the way back to basically 2009. And that's around 3,000. So if we do head to 3,000 from here, you're talking about a 25% decline in the S&P, and that's what I'm penciling in for later this year. I think a majority of this comes in the second half of 2023, but I do think we probably test that 3,000 level on the S&P. So it's not going to be a pretty year for equity investors.
And as a percentage from the market top to that drop, what would that work out to be?
I think it's around 40% or so. So I think it's right around that 40% area, which would kind of put us just below that rarity of 50% or more.
And as far as the bond market, as a trader, is the bond market something you pay attention to? Is it something that you follow? And if so, what index would you keep an eye on?
At least in terms of the bond market, I definitely do pay attention to this. And I'm going to go to the 10-year yield here real quick, and let's take a look. I'll show my chart in just 1 second. Let me get that up there. But basically, the 10-year yield is now, it looks to me to have topped out. And what that tells me is that the Fed probably is near the end of their rate hike cycle. Now, again, whether or not they lower rates that much, I don't think they will for a while. So I expect a yield on the 10-year to kind of hover between 4 and 3.25% for the entire year. So at least bond investors probably won't get hammered quite as much as they did in 2022. But I certainly don't think that they're going to reap the rewards of a new down cycle in yields. And so again, I'm looking at this as an indicator of what the Fed is likely to do. And right now it's telling us that, again, we topped out on expectations going back to October, November, and now we're in this lower trend, likely to head down a little bit more, but then chop sideways for the foreseeable future.
And last but not least, looking at the gold market. I know you're a fan of gold. Obviously, it did come down a little bit in 2022, but it held up quite well. Are you still a fan in gold for 2023?
Yes, I am. So just like in 2022, 2021, late 2021, I said that gold would be the best performing asset if you compared it to the S&P as well as Bitcoin. And it was down slightly on the year, but not by much. This year, it's already had a big rally. I'm predicting that this is the year that we will see a breakout of this bullish channel here. So upward move, consolidation for a couple of years. I finally think we break out of this 2000-ish range, and I think we will get a move up. Again, how high will that move go on gold is tough to know. But if you think about it, the stars are finally aligning for gold, because you have, number one, the Fed's going to be done raising rates, which was one of the negatives for gold, because the raising of rates made the dollar strengthen. And so if the dollar kind of is done going up and maybe starting to weaken a little bit, that's really bullish. In addition, if inflation stays elevated, let's say 3 or 4% per year, that's also a very bullish thing for gold. So I think you're coming into the sweet spot for gold. The consolidation is a beautiful bullish consolidation, but we do need to break out above this 2000-ish area to really see the big move up occur.
And if silver pretty much correlates with gold, if you're a fan of gold, then wouldn't you invest in silver instead? Because obviously when it's going up, it kind of outperforms in multiples.
Yeah, that's a great point. So the number one thing is that silver does also have that bullish consolidation pattern, right? So you do have that bullish consolidation pattern on silver. Notice how it's attacking this downsloping trend line. If it can break out, you should get significant upside. The only issue, and again, this is only a minor issue, I'm still a bull on silver as well, but just remember that silver is also an industrial metal. So in essence, if we go into a big global recession, the demand for silver, at least for industrial purposes, could drop a little bit, while the supply for safety, or the demand for safety, would then elevate. So I think that, again, gold is your pure play. Silver would be, yes, if the economy can stick in there and still be okay, then I think silver would outperform gold as well.
Okay, so as a summary then, what advice could you give for longer term investors for 2023?
Yeah, longer term investors for me, I mean, so there's a few places you can hide. It's gold, silver, those would be some places to kind of allocate a little bit of capital. And then I think what you want to do is you want to start kind of keeping your eyes open for stocks that have been really beaten down, and looking for levels that they haven't seen, like good quality names that you haven't seen in a long, long time. So for me, it's about having that dry powder on the sidelines. And just let me show you this chart of Apple. And I know Apple's a favorite of so many people. Right now, I'm bearish on Apple, and I'll show you why. So you have this longer term trend line here. It broke. We're retracing to resistance now. My expectation is it goes down. But I think once you get down to this gap fill around 93 to 94, and if it trades down to 81, and I know those numbers are scary, but that's where you want to start to accumulate. You don't want to be jumping in at these levels ahead of a potential recession. Let the panic, let the fear come in, drive prices down of good quality stocks, and then just be waiting there to accumulate. And again, I think that'll be the fine way to do it. In addition, I do think that Bitcoin does bottom in 2023 here. And I do think that there will be, again, it's very high risk, but a small amount of capital can be maybe put into Bitcoin somewhere in the range of that 10,000-ish area for a longer term play as well.
Yeah, so Apple's going to be a great one for longer term, a very safe company. I think you have to now start taking a look at Tesla. So Tesla is looking like one of these typical bubble charts, but It's now, I think last time I looked, it was down 70% from its all-time high. So if we have another downturn, surely Tesla is going to be on the cards for a lot of longer term investors. What do you think?
Absolutely. Yeah, so and I have it already isolated out here. I have this trend line here at around the $65 level. And you can see why I'm picking that level. That was a pivot high here, and then we finally consolidated and broke out. So if we could get down to this level, even I would be an interested buyer of Tesla. And I know that sounds crazy. I mean, it would still be another 50% drop from here, but don't be surprised. I mean, if we go, I mean, let's just say the S&P does sell down to 3,400 or even 3,000. These levels will be hit. And again, even if they're hit, just be aware, price can go below them in the near term, but you have to kind of inch in. What I suggest is doing what I call the dipping the toe in the water type effect, where, you don't say, okay, it's hitting 63 or 65. I'm going to put my whole amount in. You say, all right, it's hitting 65. Let me put in 1/4 of what I want to buy. And maybe every $5 down, I'll put another quarter in. And this way you dollar cost average on good quality stocks. And it can put you in a position that whenever the bull does return, then you're really participating at a great average price.
So I think I'd probably summarize 2023. If you've managed to still got some cash, if you've got some dry powder, and I think patience is going to be key for the longer term investor. When it comes to around mid-year, there could be some generational buying opportunities of a lifetime, because once it's gone down that much, your risk is really minimized and the upside is now looking really, really good.
Yeah, I think that's a great summary of how things look at this point. And again, I always tell people that in bear markets will generally go down more than you think. So, when I'm talking about these levels on some of these charts, a lot of people probably are thinking, oh, that's crazy. But a great thing to do is go back to past cycles, right? If you go back to 2008, 2009, did anyone think the bank stocks were going to be penny stocks before they roared back? And the answer is no, none of us did. And so always remember it can get worse. And the best thing about it is to have money on the sidelines ready to invest. I mean, if you were buying banks at those levels back then, the amount of money you made is unbelievable.
Well, brilliant. So where can people find out more about you, Gareth?
Twitter's a great spot. I'm on Twitter. I post a couple times a day at Gareth Soloway. If you're interested in stock trades and signals, inthemoneystocks.com is where I can be found. If you're into crypto, verifiedinvestingcrypto.com.
Gareth, thank you for your insights. Pleasure as always. And we'll catch up again a couple of months down the line.
Wonderful. Thank you for having me. Great to talk to you.